Coming up today, stocks finish lower on the back of trouble in chip makers, the threat to Western property prices, the latest earnings results, oil continues to fall, and it's Fat Tony right, and we're on the verge of a complete market collapse. It's going to be a good one, guys. Let's go. And welcome back, everybody, to the Daily Market Review. My name's Jared, and if you're like me and you're into swing trading and active stock investing, then smash that subscribe and like button, because every day, a few hours after US market close, I make these deep analysis videos to keep you all up to date on everything important happening all across global financial markets. And so it looks like we had a little bit of a turnaround day today. Bit of a bearish engulfing candle here on the S&P 500, just sitting above 5,800. However, it wasn't a complete bearish breadth of a day. Still see a rotation going on up the front here, with sectors like REITs finishing higher, as did regional banks, actually breaking out to a fresh yearly high. Gold miners pushing up, and even retail stocks having a good day. And stick with me today because I'll show you the latest earnings releases we've got today, along with touching on crude oil, which is continuing to fall, dragging down energy stocks today. I'll also get you updated on China, which is continuing to pull back. But the biggest moves we got today coming out of semi-stocks, chip stocks, the AI trade. Semiconductor sector down 5.4% today on pretty heavy volume. That's a pretty heavy candle right there. Just as we had NVDA closed at its brand new all-time high yesterday and maybe looking to push off this resistance zone. Was looking shaped to break out. However, big chip maker, ASML from the Netherlands, 350 billion market cap, accidentally leaked earnings early on their website today, and they weren't all that great. Stock got absolutely slammed, down over 16%, as they cut their forecasts, gave the whole sector a bit of a growth scare, on the back of them citing weak demand from chip makers for their machinery. And this is on top of reports today that some of the biggest chip makers in the sector may be facing further chip export curbs. The current administration could be considering restrictions on Middle East countries as well. They've done the same with China and advanced GPU AI chips, but now they're potentially looking to expand that. So is this growth scare from ASML today just isolated to them? Will further controls on curbing AI chip export to Middle Eastern countries move the needle when it comes to NVIDIA profit? And is this just an overreaction? Well, first, this is what makes short-term trading difficult. The chart can look as good as possible, then you get some surprise news coming out from the government like this. However, in my opinion, this could just be a short-term blip, because I think even if those export controls go into effect, NVIDIA's still not going to have any problem selling all the GPU they can possibly produce at pretty much whatever price they want as well. However, nonetheless, it was a pretty big technical rejection from this resistance zone. So we may get a bit of follow through tomorrow, the rest of the week, but we still have a lot of bullish seasonality coming into this stock. So I think the dip may get bought even before we hit the 50-day VWAP, which is currently around 119.5. And so just looking at Bank of America's Global Fund Manager Survey, it's actually geopolitical conflict that fund managers are considering the biggest tail risk in this month. It's gone up a lot since last month. And what's really contracted from last month is their view of a US recession being the biggest tail risk. Dramatically contracted, actually, from September to October here. Coming in second now is global inflation accelerates. And that's pretty much the theme we've seen play out in financial markets. Ever since the Fed cut rates on September the 18th, we've seen markets price in a lower chance of a recession and greater chance of inflation coming back, almost like clockwork, whilst we've still got elevating geopolitical tensions at the same time. Down the bottom and contracting further, systemic credit event. Bond markets are pretty chill, not forecasting any storms right around the corner anytime soon. And the fact is, we just have this huge boom in capex, capital expenditure by company. Cashed up, mega cap tech, they're expected to spend almost $250 billion next year on capex, up 14% from this year. The rest of the market's expected to spend $870 billion. Pretty sharp increase from where we were just a few years back. And the fact is, the bull market just turned 2. Still a young bull market. Looking back in history, we're pretty much at the average mark for how much the S&P 500 has gained 2 years into a bull market. Currently 60%, typically averages around 58% at this time. And in fact, the last 2 bull markets, they were both up 93% 2 years into them. So by that measure, we're not really that stretched. However, that's just only one measure. Can't view anything in a vacuum. And the difference between the last kind of short-lived bull market, bull run, or whatever you want to call it, from the COVID low to the 2021 peak, is that was driven largely by a huge bounce, huge liquidity injection from all levels of government, but also an expansion in valuation. Basically, investors getting more excited about owning stocks. That's why the trailing 12-month PE ratio got up to 33 come the peak. And even though stocks are up 38% since then, they've actually gotten cheaper since that peak. As this bull market so far isn't just investors getting excited, but also actual earnings growth and a broadening of earnings. But nonetheless, still not a cheap trailing PE at 26 either. But just keep in mind, when we're looking at PEs for the S&P 500, it's heavily skewed by those mega cap tech. A lot of them trading at PEs 30, 40, 50 or more because they're growing like crazy and printing more cash than a bank. And we can see that in S&P 500 cap-weighted trailing PE, currently around 25, where the equal weight trailing PE is currently around 20. If you look at the Russell 2000 small caps and you strip out those unprofitable biotechs, which make up a large portion of the index, PEs are actually around 12, 13. Profitable small caps are actually cheap, just like some international stock market. So anyone that makes that broad statement, oh, the market's overvalued, well, you got to ask them, what market are you exactly referring to? Because there's big differences out there. And even though the US has absolutely crushed international markets last 15 years, again, it's for good reason. Pretty much just been keeping up with earnings per share. You can see here in the dark blue, the price return of world stocks versus the US significantly underperformed, but so is their earnings per share, pretty much correlating perfectly actually. But those record valuations, they've got a lot of people convinced we're on the verge of a complete collapse. Another post showing up on my feed today, a rising wedge chart pattern is extreme at highest market cap to GDP in US history. This is the blow off top to the mother of all artificial bubbles and a highly reliable pattern short. Not only that, Black Swan author Nassim Taleb, who also refers to himself as Fat Tony, saying that collapse risks loom as markets are the most fragile they've been in 20 years. Said he's focused on hedging against market collapse, just like he has been for the last 20 years, and said the market's flashing parallels prior crashes. He pointed to risks like high debt levels, crazy stock prices. Keep in mind he's an economist and an author of books. He does advise an investment firm. I think they're focused on tail risks, so he could be literally talking up his own book. And this isn't anything new either. We've been hearing about this for years and years. A lot of these authors pretty much come out each year with a new warning, new wording, new theories. However, I don't take my advice from men like this. I prefer to put my chips behind men like this. The owner of the football team Carolina Panthers, billionaire hedge fund manager David Tepper, been in the business for decades, worth more than $20 billion, has an excellent track record, up there with the best of them, and he's been betting heavily on Chinese stocks this year, holding a similar view to that of myself. And speaking of China, we got some interesting news out today. They're moving to tax the ultra-rich for overseas investment gain. Years and years, rich Chinese got their money out of the country, buying up property in Canada, Australia, New Zealand, America, London, you name it, helping to propel Western property prices to the most rich valuation levels they've ever reached. Now the Chinese government is looking to clip their ticket on them, and that could pull back investment going forward, if not result in some sale. Either way, it's been a huge tailwind for Western property markets for years now, and that could be going the other way. As China does have problems, even though their economy is still growing, the rate of growth has been drastically slowing this last couple of years. Look at this dive in China financial institutions' loans year-over-year growth. It's only at 8.1%. That's a nosedive level for them. As credit's normally used to growing in double digit, huge build out of property, markets had to contract to wash out excesses. And that's what capitalism does. Washes out the weak, keeps the strong. However, in modern day markets, we have governments intervene into them. We don't let the forest completely burn down. And the Chinese are starting to do what the Americans have been doing a lot the last 15 years. And that's directly intervene in markets, significantly increase liquidity in order to prop them up. And the Chinese government are in the best position to do this. They've got more reserves than the US, Europe and Japan combined. They've got a lower debt to GDP. They've got way more room to stimulate here. And so even though this is going to take some time to play out, it's not going to be a walk in the park, this chart could put in a V-shaped bottom. As according to a Chinese analyst, one after another, China's major cities are reporting brisk property sales in October, following Beijing's move to ease property restrictions and lower mortgage costs. These are green shoots of a recovery. By no means are we out of the woods? Not yet, but this is good. And so, like I said, they're pulling out all the stops one by one to try and get underneath their declining growth, issues in their property and other capital markets. Getting reports they may raise $846 billion with ultra-long special government bond, with the funds being used to help local governments relieve their burden from off-balance sheet debt, in which they face heavy criticism, being accused of hiding huge amounts of debt off the books under their local government, which I'm sure there's truth to. But like I said, they've got plenty of room, plenty of cash on hand to clean all this up and stimulate. And there's a look at the China 50 index. Still pulling back, now approaching the golden pocket, up to a 65% retracement of this swing move, and we're getting that same retracement on Tiger Brokers as well, which I bought the dip on again today and plan on continuing to do so the lower it trades, as I'm making a long-term bet on the growth coming out of Southeast Asia, and this gives me good exposure to the trading of Chinese shares from a company that's headquartered in Singapore. Like I said, doesn't have that direct China risk. However, as we can see, it is hugely volatile, moving around a lot, and so that's what I'm looking to take advantage of. But just moving back to the States, Q3 earnings season ramping up here. we got United Health out today, beating expectations, but the stock is falling pretty heavily actually. One of the biggest components in the Dow Jones Industrial Index, but according to analysts, United Health said it paid out 85.2% of its medical premiums to cover medical costs, which was a lot higher than what the street was expecting, and thus we got a big dip in the stock today for a big blue chip like United Group. Down 8%, did do a big spinning doji there. Looks like investors bought the dip, and we've still got the biggest health stock, Eli Lilly, holding ground just below highs, market cap $868 billion. We also just heard earnings from Goldman Sachs, beating on profit and revenue as stock trading and investment banking boosts results, which is a pretty good sign for a healthy market. Investment banking revenue jumped 20% on strength in debt and equity underwriting. Equities trading, 18% revenue increase. Earnings well ahead of what the street was expecting. Profit surging 45% from a year earlier. So that's a pretty good result from one of Wall Street's oldest investment bank. And the market loved it as well, gapping up to new all-time highs before doing a bit of a reversal like the rest of the market today. But we also had earnings from BlackRock a few days ago, with them too just breaking out to all-time highs. BlackRock barometer. It's looking really good here. We also heard from Walgreens today. Stock's been battered down for the last couple of years. Really struggling to keep up with the secular trend from physical to digital. Still closing stores. Just announced plans to close more than 1,000 stores, but did beat on quarterly earnings expectation, along with their revenue as well. Still a big business, $37.5 billion in sales for the third quarter, and they're going through a bit of an adjustment to the business, trying to turn things around, get more lean, trim the fat, focus on profitable stores, and they still have over 8,000, but only 6,000 of them are profitable. So we're likely to see more store closures as they become a smaller business. Market appeared to like it. Getting a classic dead cat bounce there today. Fat green candle. Moving off this rounded bottom low on a big bullish divergence. And this stock too is likely to remain wildly volatile. But nonetheless, does have the potential to be a good turnaround. My stock fair value indicator has got fair value at $35 a share. But obviously still at a pretty persistent downtrend. If management can turn this around and even get back to half of what the stock was trading at 2 years ago, this will be one of the best turnarounds from a former blue chip that actually used to be and the Dow Jones Index itself as well. So moving on global macro, a changing narrative of the potential for inflation to come back. Even hearing the changing tune from the Fed. Market's expectation, definitely starting to price that reality in. Luckily, we've still got crude trading heavy, but the bond market may be at risk from inflationary forces beyond the Fed's control. Obviously, the Fed can't control federal government spending. That's fiscal policy. They only look after monetary policy, in which their biggest job function is to set interest rate. Their double mandate of keeping a fully employed economy and also keeping inflation low. But what makes their job hard, apart from all the printing they've done themselves, is government spending, which seems to have found a completely new trend line post-COVID. Significant jump from the prior years, in which it was already been criticized of accelerating too fast. Now we're in a whole new dimension. And like I always say, it's not just the US government, it's governments around the world. And you'll find this all throughout history. Governments tax too much, spend too much, become corrupt, become bloated. They just waste capital like no other to the detriment of everybody. Because there's no accountability, very little transparency, and there's no motive for profit, nor punishment for loss like there is in the private sector. And someone came out with a good post highlighting that today. California high-speed rail, picture on the left, is apparently blowing out in cost and delays. Looks like it's going to potentially cost taxpayers up to $100 billion. In contrast, SpaceX developed a Starship for under $10 billion. Literally flying a skyscraper into space and returning it back down to Earth, been caught by some metal claws. Classic example of bureaucracy versus capitalism. And that's what a good entrepreneur and businessman does. Finds efficiencies, makes things cheaper, quicker, faster. And SpaceX has absolutely revolutionized space travel, getting satellites into space, reusable aircraft. We can see that in this chart here. The price per kilogram of the cost to launch to low Earth orbit. Today, launching a spacecraft is 10 times cheaper than it was a decade ago. And SpaceX is determined to get that cost as low as possible, which opens up a whole new economy outside of Earth. Another interesting chart I thought I'd share with you guys today, just like that one yesterday that showed over time, secular bull market, and the stock market getting bigger and bigger over time, along with valuation, showing a secular uptrend of higher highs and higher lows. This is a long-term chart of interest rate, going all the way back to the 14th century, and it too, showing a secular trend of lower highs, lower lows. In fact, the annual real rate of trend change, minus 1.96% per annum. But like a lot of markets, you can see those big cycles up and down. And so maybe we never see rates above 10% again in our lifetimes, or even our kids' lifetime. Most Western governments can't even come close to affording rates back there. Even at 5% is a real struggle. And so if rates can't go back above there, along with huge amounts of stimulus, what does all that do for an inflation going forward? Or is it a case of just humans and their management of economies and markets becoming more efficient over time, getting better at managing businesses and economies, and technology, which is anti-inflationary? Maybe all that has had permanent changes on market. Either way, it's interesting to step back and look at the big picture to kind of understand where we are relative to history. Moving on to commodities and oil, dropping sharply again today as we're getting news that Israel won't target Iran's oil facilities. Just as I had forecast last week, I didn't think they were going to go ahead with that, as was widely speculated, as that would greatly upset their allies. Instead, we're getting news they're going to go after their military assets instead of their nuclear facilities as well. And I know we've been hearing the same thing for a few weeks now. Their strike inside Iran is imminent. We're hearing that once again. Apparently, it's just been approved for some reason, keeps getting delayed. So for sure, we could wake up any morning now and hear of their response back on Iran, and we'll just wait to see what the Iranians do in return, which of course may take them another couple of weeks to work out as well. And this is on top of news that the Saudis could flood the market with oil to regain control of prices. And they're given that threat if OPEC does not commit to reducing oil output. For a long time now, they've wanted to reduce output to prop up prices, but the rest of OPEC members have not agreed. Got Russia pumping it out like crazy, and other OPEC members, along with African nations, pumping it out, and that's helping to keep downside pressure on oil, which is still very volatile. However, we're coming down in low volume here. I think there's a good possibility that these high 60s may be a bit of a buy the dip area, if not down to 67, 66. Do have a bit of bullish seasonality over the next week or two, and I don't think those tensions in the Middle East are going away anytime soon as well. And if China is able to rebound, and the US economy continues to hold up, along with Europe and Japan, and that should keep oil floating around $70 a barrel. However, there are still upside risks as well if we do see a big disruption in oil supply in the Middle East. In my opinion, gold staying firmly bid here, probably on a geopolitical risk premium. And we've got agricultural commodity potentially shaping up as well. And so I know investing in China comes with the risk that if they go into Taiwan, they could be cut off from Western capital markets for sure. However, I think it's much more unlikely that's going to happen like it did with Russia. Remember, as soon as Russia went into Ukraine, the Russian ETFs in New York absolutely nosedived for a few days before being delisted. I'm sure a lot of people got caught up in that. However, America is much more reliant on China than they are on Russia, just like the Chinese are really reliant on the Americans. You could kind of think of it, it's like a bad marriage, and they're just staying together because of money and the kids. And that's because America imports a lot of rare earth materials, critical mineral from China. In fact, they get 100% of some critical minerals from China, and others 90, 80% or more, whereas Russia doesn't even show up in this list here. Just like the Chinese need America, as they still export a lot of goods to the Americans, still sell a lot to them. A lot of people are employed in China because of the American consumer. So like most things in the world, it's very complex. You can't just break it down into a binary on or off. There's a lot of gray area. And so even though there may be a regional conflict in Taiwan, may not be a full-blown decoupling of America and China, where they just don't trade with each other at all, don't allow each other to access capital markets, Chinese companies to list in New York, American companies to do business in China. Could definitely get tense and messy there if they do go into Taiwan. However, like I said, I don't think there'll be clean cutoff from Western capital markets like Russia, but of course, I can't rule out that possibility 100%. Just moving over to the economic calendar for today. Unemployment in the United Kingdom coming in lower than expected as well, 4%. Versus 4.1. Good jobs report. 373,000 new jobs created in August. Huge beat on the 250,000. Their jobs market's holding up okay as well. Same with inflation in France. Coming in lower than expected year over year. Only 1.1%. Even just getting a little bit of deflation month over month. Industrial production in the Eurozone, a bit better than expected as well. Inflation in Canada, better than expected as well. 1.6%. But the manufacturing index in America, lower than expected. So overall, globally, inflation's coming down. Jobs market's holding up, along with interest rates coming down. The market can keep holding on to that setup, and that shouldn't be too bad for stock market. Looking out till tomorrow, get inflation data from United Kingdom, jobs report from Australia. Into Thursday, interest rate decision from the ECB, weekly jobless claims as usual, and retail sales, along with some retail earnings. Rounding up Friday with some housing data. We've got Fed Fund futures pricing in 94% chance the Fed will trim 25 basis points next month. Got a little bit of a pop there in the VIX today. Still holding on to that 20 handle. Option dealers still demanding 10 points of premium to underwrite volatility here. And we're getting a little bit of a pullback in 10-year yield today, down to 403, which like I mentioned yesterday, TLT was looking a little technically oversold. Get my reversal signals firing off. Got a bit of a bounce there today, along with the dollar. Looking a little stretched in the short term. Bearish seasonality, reversal signals, DSI overbought, institutional buying gone negative. We may be close to a bit of a short-term top here, especially if yields are pulling back a bit as well on the dollar. Although we're not that far above the 50-day VWAP. Like I said, we could still push up to 104, but whenever you see my reversal signals, it's showing signs the market could be nearing exhaustion. Another good move up for Bitcoin today. Even though we got semi-chip AI stocks pulling back, like I've been saying lately, global liquidity's gone vertical, and we could be about to get a pro-crypto government. Along with bullish seasonality, I think this consolidation we've been in pretty much all year may just resolve itself higher. And there's a look at Tesla, pretty much coiling up again today, just seeming to hold on to that gap down we had last Friday. And it was the energy, oil and gas stock taking a bit of a pullback today. Along with materials, we've kind of been trading in line with Chinese price action of late, but we've still got big companies like Walmart actually breaking out to a brand new all-time high today. Been an incredible performer this year. And it was once again small caps holding up well today, actually finishing slightly higher, even though we had the Nasdaq down 1.3%. And there's a look at my sector breadth table indicator. Energy pulling back up the front, along with health and tech. Actually got REITs and utility bouncing up here today, along with staples. Bit of a defensive rotation there. Not a huge amount, but like I said, pretty heavy candle there in semi, with NVDA pushing off those all-time highs. I'll be looking for it to defend its 50-day here in the next few days as we move closer to their earnings. And that's pretty much a wrap for the daily market review today. Thanks very much for tuning in. I appreciate all your support, and I'll see you back here this time tomorrow. Cheers.